Okay, let's dive right into this explainer. Today, we're decoding a company's true financial obligations. When we evaluate a business, it's super easy to just stop at what's obvious on the surface. But today, we're looking way beyond traditional bank loans.
Because think about it, we naturally think of corporate debt as just bonds and loans, right? The straightforward borrowing of cash. But what about the massive, kind of hidden promises companies make every single day? We're talking about contracts for global office spaces, entire fleets of delivery vehicles, and decades-long employee retirements. These are enormous financial commitments that can absolutely make or break a company's long-term solvency.
Just to put this into perspective, listen to this jaw-dropping number. A 2014 study by the International Accounting Standards Board found that publicly listed companies owed more than $3.3 trillion in future lease payments alone. $3.3 trillion with a T. That is an unbelievable amount of capital that needs to be properly accounted for, just so analysts and investors aren't flying blind.
So here is our roadmap. Today, we're going to trace the risk and follow the money through three really complex areas. First, the hidden debts and promises in leases. Second, navigating the intricate world of pension plans. And finally, unpacking share-based compensation. Let's get into it.
Starting with Section 1, Hidden Debts and Promises, and the complex world of leases. We're going to see how a seemingly simple agreement for office space or equipment can totally alter a company's balance sheet. Fundamentally, there's this underlying tug-of-war over who essentially owns the asset's economic reality. On one side, we have the lessee. That's the party actually using the asset and making the payments. On the other side is the lessor, the party who legally owns the asset and collects those payments. Sounds simple, right? Almost like renting an apartment. But corporate leasing is way more nuanced than that.
And that brings us to our first major contrast. A lease is basically categorized in one of two ways: an operating lease or a finance lease. An operating lease is just what it sounds like. It resembles a simple, short-term rental contract. You use the asset, you pay the fee, you return it. No big deal. But a finance lease, now that resembles a debt-financed asset purchase. It means the lessee effectively controls the economic benefits of the asset for most of its life. They're essentially buying it on an installment plan.
So how do accountants actually decide which is which? Well, there's a really rigorous litmus test. Does the lease transfer ownership at the end? Is there a purchase option the lessee is reasonably certain to use? Is the lease term for a major part of the asset's useful life? Or does the present value of the sum of the lease payments equal or exceed the asset's fair value? Here's the kicker. If an agreement meets just one of these definitive criteria, accountants have to classify it as a finance lease. Bam! That hidden debt is brought directly onto the balance sheet.
Now, while lessor accounting is almost identical across the board, lessees actually face a branching path. Their reporting reality changes dramatically depending on the accounting standards their company uses, specifically whether they follow IFRS or US GAAP.
To summarize that branching path, IFRS takes a really strict approach. It forces lessees to treat almost all leases as finance leases. This is a single model. It means recognizing both a right-of-use asset and a corresponding lease liability on the balance sheet for virtually everything. US GAAP, on the other hand, still maintains a dual model. It distinguishes between operating and finance leases for lessees, and that significantly changes how expenses are recognized on the income statement over time. Okay, shifting our focus from physical assets to human capital, we have to ask a massive, multi-billion-dollar question about retirement promises. When a company promises a lifetime pension, who actually bears the risk if the market crashes?
Let's move into Section 2, Navigating Pension Plans and the Shift of Risk. We really need to dive into post-employment benefits to see how the burden of market performance totally dictates financial reporting.
Notice the dramatic shift in risk allocation between the two main types of pension plans. In a defined contribution plan, think of your standard 401k match, the employee bears the investment and actuarial risk. The employer simply makes a defined cash contribution, records a straightforward expense, and boom, their job is done. But a defined benefit plan? Oh, that is a complex, ongoing corporate promise to pay a specific formula-driven amount in retirement. Here, the employer bears all the risk, which creates massive, incredibly complex assets and liabilities.
For those defined benefit plans, companies have to constantly measure the present value of their future promises, that's the obligation, against the actual money sitting in the pension trust fund, which are the plan assets. If the fair value of the assets is greater than the obligation, fantastic, you have a surplus. That's reported as a net pension asset. But if those decades of promises outweigh the assets on hand, you got a deficit, and that sits heavy on the balance sheet as a non-current net pension liability.
Let's see how this builds into the reporting standards. Accurately predicting decades of pension obligations involves highly volatile assumptions. We're talking mortality rates, expected salary increases, market returns. Well, US GAAP actually allows companies to smooth out this volatility in pension expenses over time, spreading out those actuarial gains and losses using a 5-component model. IFRS is much more direct. It uses a 3-component model where those volatile remeasurements go straight into other comprehensive income, keeping them entirely off the main income statement.
It is absolutely fascinating to see these exact concepts applied in the real world. Take BT Group's 2018 annual report, for example. They explicitly state, the group's net obligation in respect of defined benefit pension plans is the present value of the defined benefit obligation less the fair value of the plan assets. I mean, it is literally textbook accounting playing out right there in corporate disclosures. Looking closely at BT Group's numbers, we can see exactly how this plays out financially. In 2018, the present value of their liabilities was over 57 billion British pounds. Meanwhile, the fair value of their plan assets was roughly 50.9 billion. That multi-billion-pound gap, the deficit between the promises made to employees and the actual cash and investments on hand, is exactly what determines their net retirement obligations. It really is a striking look at the sheer scale of these long-term liabilities.
All right, moving into our final section, share-based compensation and aligning interests. Let's explore how companies heavily compensate top talent without spending a single dollar of cash today.
So the absolutely crucial point here is that stock options and share grants are incredible tools for retention. They serve to completely align employees' interests with those of the shareholders. Obviously, if the stock goes up, everyone wins. And best of all, for the company's treasury department, it doesn't require any current period cash outlays. But just because no cash leaves the bank doesn't mean it's free. This compensation must be meticulously valued at the grant date and recognized as an expense over the entire vesting period.
Because no cash actually changes hands up front, accountants have to rely on complex mathematical valuation models to figure out the fair value of what was just given away. Key inputs for an option pricing model include the exercise price, the expected volatility of the stop price, the estimated life of the award, forfeiture estimates, dividend yields, and the risk-free interest rate. Honestly, altering just one of these assumptions can wildly change the reported compensation expense that eventually hits the income statement.
Ultimately, understanding leases, pensions, and stock-based compensation is the master key to unlocking a company's hidden reality. These aren't just little footnotes at the back of an annual report. They are fundamental trillion-dollar drivers of financial health, leverage, and operating risk. So if you only look at traditional bank loans and bonds, are you really seeing a company's true leverage and operating health? Keep digging into those disclosures, because you have to wonder what other obligations might be hiding in the footnotes.